you. So today I'd like to talk about money and banking based on my joint work with John Moore. And the question we want to address is under what environment does liquidity created? And also when the circulation of inside money is essential for smooth running of the economy, and how the financial deepening intertwines with economic development. And to do this, we emphasize the two forms of limited commitment. One is the bilateral. Debtor may default to the original creditors. So that creates the standard borrowing constraint or collateral constraint. And the second question is, does the original creditor can sell this her credit to somebody new, a new financier in Doug's language, and but debtor may default to the new persons, and then the credit doesn't circulate, or the secondary market for the debt may collapse. And that's the question of limited liquidity. Or first session, we talk about market liquidity, and that's related to this. This is more like a borrowing constraint. This is about liquidity constraint. We want to use these two frictions to understand the money and banking. And to do this, we give the little one model, actually, instead of many models. And it's almost like a medieval model. Without uncertainty or anything, we don't assume bankers or money. And actually, there is one type of agent, and one homogeneous goods, which is perfectly storable, and everybody consumes every period, and deriving utility, decreasing marginal utility way. So everybody wants to consume some, and everybody can produce. They can produce using the goods as an input to get the output 2 periods later. 2 periods is a metaphor for long term, actually. But this is the actually decreasing return to scale, which means actually the producer's human capital is essential to produce this output. And lambda, this is like a increasing marginal cost parameter or decreasing return to scale parameter, which is the same as the share of human capital. And the agent, human capital is needed, means the agent is fully engaged from beginning to the end during the investing time, growing time, and the harvesting time. And they cannot handle the two projects simultaneously. And therefore, earliest time they can start the new projects is date T+3. And there is a fixed supply of money at the beginning, and also there are some little endowment to kickstart the economy. That's the model, actually. And so this is the framework. And what's the solution? Do you have any guess? So this, you have three population, 3 people, and decreasing return to scale, and the decreasing marginal utility. That's the model, and nothing else, actually. And the answer is because of people doesn't have any disutility of labor, they should work every period, right? So full employment is one consequence. And also, second consequence is consumption should be smooth. So that's the requirement. So therefore, the first best allocation without any other frictions have a feature like this. First group, there are 3 groups of people at the end of the day will start emerging endogenously. First group starts the production at date 1 and finishing date 3, and starts again state 4. They shouldn't take any nap in between, actually, because that's a waste of the human capital. So they should keep working, and every 3 periods starts, and 2 periods later finish. And the second group starts second period, and then starts 5 and 8. And the third group is starting the stage 3 and starts 6 again. And every period, some people are finishing, getting the harvest, and some people are starting. As a result, resource constraint says the output, finishing, harvesting people's output, is allocated between investment for the starting people, investing people, and consumption. And consumption should be perfectly smooth for the best allocations. And that's the best, first best allocation. What's the size of the project? Size of the project should satisfy the marginal conditions. Marginal cost should be equal to marginal return. Marginal return is 1, but it comes 2 days later. Therefore, marginal return in discounted sense is p squared. So that's the model. And so how can competitive economy achieve this first best allocations? And the answer depends upon frictions. The first friction we introduce is a borrowing constraint. Basically, the agent can not commit to pay more than theta fraction of output. Here, the philosophy is the people are not so trustworthy, but you can rely on assets as a collateral. The Donald Trump example, like Trump can set up a new companies and multiple legal identities. Therefore, the Trump's identity is not the good collateral. But Trump's asset can be a collateral. But the asset is not the perfect collateral because of they have a specific skills. If somebody else try to succeed, they only get the theta fraction of output. That's why liquidation value is a theta. And next question is, although the project provides deterministic output, Y, it consists with many parts. And some parts, alpha fraction is going to fail. And the remaining -1 minus alpha yield Y. But after investment, the middle period, growing period, the original creditor learns which part is failing. And they can separate it out and selling this part and to the third person, new persons or other financiers. And then this will create the adverse selection problem. If failing part is big enough, or the remaining part is too good to sell, actually the good part is retained, and the bad part is, of course, in the market, and the market collapse. And that's the standard adverse selection creating the problem of secondary market. So this is the reason resellability constraint arises. How do you overcome? The answer is bundling. Basically, if you can bundle the project, not all of them, maybe Z fraction of project is bundled with additional cost, the 1 minus phi over phi to the GZ. Phi is a parameter of how easy is bundling. And if phi is 1, it's costless to bundle. And if you bundle, then this part will not be separated in the middle date. Therefore, it's not subject to the adverse selection problem. And they always generate output Z. And that's almost ideal situation for securitization. Each part is subject to the idiosyncratic risk, but putting together, you get the deterministic output Z. And this bundling is our banking. Basically, the nutshell of our model is you can spend extra resource to bundle, and therefore creating the liquidity. It's a bit different from the Doug is talking about, but somewhat related. So this is our physical way of thinking about, instead of the commitment for sequential service constraint. And so this bundling is, of course, wasting the resources from first test point of view, but it may help to lubricate the economy. So let's look at a little bit on how the life of the people look like. The Q is the price of non-resellable unbundled paper, which you cannot sell before the maturity date. And the N is the quantity. P is the price of the bundled paper, which mature next period. And M is a quantity. So investing agent requires investment cost and the bundling cost and the consumption and the purchase of liquid assets or illiquid two-period paper. How do you finance? Partly issuing the liquid paper by bundling. And liquid paper will mature 2 periods later. Therefore, the 2 periods liquid paper price is a P square. While the y minus z part is unbundled, so you cannot sell it. The price is Q. And this is the external financing. So, but if you cannot borrow 100%, they have to finance from your own funds. And partly come from the last period saving, liquid saving. And partly coming from the 2 periods ago saving from the growing period. Actually, if you have a borrowing constraint, you have a sequence of budget constraint. Here, actually, it's not just a sequence, but you have to look at the multi-period. And there is a little bit of hole. So John and I used to call it the holy budget constraint because there are a lot of holes in the budget constraint. And the growing period, they consume and buy the liquid assets and buy the illiquid assets too, financed by the liquid saving and the illiquid saving coming from 2 periods ago. Harvesting time, consumption and liquid and illiquid saving is financed by the output after paying the debt to the creditors. You might say you don't have to borrow up to the limit, but it's the same as you borrow up to the limit and retain some of the paper by yourself. So that's the after repayment of the debt. And you might have some saving from last periods. And what about the market? Market is the goods market. Output is either consumed by 3 groups of people, investing, growing, and harvesting people, and the investment, as well as bundling cost. It's a payment to the bankers in some way. And the blue paper market is the illiquid paper is supplied by the investing agents and bought by the various savers. And liquid paper, there is 2 kinds of liquid paper. One is the paper which mature next period. The other one is a paper mature 2 periods later. Therefore, next period value is P. And this paper, it's used twice is a trick to actually provide extra liquidity. And Knut Wicksell defined the money as some object accepted in trade, not for own consumption or production purpose, but for further exchange purpose. This is actually the satisfied medium of exchange. People accept 2 periods liquid paper, not for consumption purpose or investment purpose, actually for reselling purpose. And that's the liquidity. And on top of this inside money, if the P is 1, this is a steady state, then you can have a fiat money to circulate. Of course, the goods are perfectly storable, so goods can be stored, but actually fiat money is better way to save for the medium, small, short-term purpose if the P is 1. If P is less than 1, there is a positive interest rate. Therefore, there is no the fiat money circulations. And the result of this is the following picture. Basically, if there is a horizontal line, how much the people can borrow. The vertical line, how easy is the bundling, or how much people can commit multilaterally. And if the theta is very low, borrowing constraint is very tight, actually the cash is the dominant means of saving. And little bit of private borrowing, the interest rate is 0, and the borrowing constraint binds for the investing agents. Here the marginal return on production is higher than time preference rate or rate of return on assets, but they are facing the borrowing constraint. And the output is lower than fast best, and the consumption is zigzagged. Like highest when they are harvesting, it's like eating like a Viking. and then the starving before the harvesting time. So, and this is the picture, like top is the investment, and the bottom is the saving. And the saving majority is the cash, the outside money. But if the economy develop a little bit more, so people can commit a little bit more between these two lines, then what happens? The people are going to create the inside money. So they start doing the bundling. And the reason bundling is happening is the rate of return on illiquid paper has to be, or is higher than the liquid paper or liquid. So this gap, you can call it the liquidity premium. So people are like the liquid paper, therefore they are happy to hold even if rate of return is low. There is a gap between the producer's return and the illiquid paper. This is called the like an agency cost wedge, like a Bernanke-Girdler's piece call it. So any kind of borrowing constraint has a agency cost wedge between the marginal return on production and illiquid paper. But on top of this, we have a liquidity premium. That's the new part. And now consumption and investment is borrowing constraint is binding for investment people, and the investment and the output is lower, but also consumption is now and here actually the lowest consumption is the investing time. This is the time they are starving. And the pattern of exchange is for short-term saving purpose, they use the cash or inside money. For long-term purpose, they are holding the illiquid paper. And so we call it the specialized saving. This liquid paper's return can hit the zero lower bound too. And so cash and inside money can circulate together. And if you go beyond this, this is the balance sheet of the typical agents. Investing agent is borrowing money by issuing the liquid paper, illiquid paper. Simultaneously, they are holding the illiquid paper. And defining characteristic of financial intermediation is they borrow money as well as lending money. Although we are saying this is the producers, they are doing the same thing. They borrow as well as lending money. And the middle date, there is a lot of the investment, and the final date, they don't have a debt after repayment. And if we have a more the borrowing, actually what happened is the people start using the illiquid paper not just for mid-date consumption purpose, for also financing the investment purpose. This is holding 4 periods instead of 2 periods. And this is overlapping saving of the illiquid paper. And you can see this case, despite of these producers, they hold a lot of financial assets. They issue the liquid and the illiquid paper, but simultaneously they hold the illiquid paper. And when they're harvesting, they actually have 2 types of illiquid paper. They bought from last period, as well as they are buying the new one. So they have a tons of papers. And this is recently true in many non-financial corporations, like about even non-financial corporate sectors, farm sectors, about in US, about 20% of total assets is financial assets. In Japan, it's about 40%. And so this is the aspect, actually, you can, if you have a lot of the bilateral commitment, you can do. And in fact, actually, if you have enough the bilateral commitment, you can achieve the fast best even without creating inside money. This is like a ROW economy. ROW economy don't have any liquidity. They all trade at day zero. And this economy, if you have enough bilateral commitment, close enough to 1, actually the rate of return on the liquid paper, illiquid paper, and marginal return on production all become equal to the time preference rate. This is the standard macro model before the financial crisis. And so that's the model. And this is the fast best allocation. We can say by using the intertwined the illiquid paper, you can achieve the fast best without relying on liquidity. And so we can say this is a pattern of exchange as well. And there are 2 elements. One is the bilateral commitment. The other is the multilateral commitment or efficiency of bundling. If it's very low, economy is predominantly outside money, and the inside money is not created. But if you have enough commitment, bundling starts taking place, and inside money and outside money are both used as a means of saving. And if it's more easy to bundle, actually the inside money will dominate the outside money. Outside money stops circulating. Our hotel is cashless, like a hotel, and they don't use the cash here. So, and of course, if you go all the way here, full bilateral commitment, actually, we don't even use the money. And whether we go to this region or not is debatable, and probably the speed of transaction become much faster than the just 3-period cycles. And also, part of the debt is actually promised to pay the money. So therefore, money may not be disappearing as a unit of contract. But that's the debatable things.
Thank you very much, Nobu. The first commentator is Neil Wallace.